My name is Carrie Russell. I am the Senior Managing Partner at HVS here in Vancouver. HVS is a hotel consulting and appraisal firm, and we're sort of known for writing the book on how to appraise hotels. I am based in Vancouver, work primarily in Western Canada doing feasibility studies and appraisals for hotel properties. There's a variety of factors right now that are coming together to drive valuation growth. I mean, first off, the demand for accommodations in Vancouver is very strong. We've got a lot of various sources of visitors that want to come to the city. So whether it's tourists coming for a leisure experience, we've got a strong corporate market, and then meeting and group travel is healthy in Vancouver. So over the past decade, we've seen demand for the city grow as a destination, and that's combined with a contraction in supply. So throughout the pandemic and even prior to that, we had seen hotels converted to alternate uses. So over the last 10 years, we haven't had new supply in the city, we've actually had a contraction. So the combination of strong demand, tight supply, and you couple that with Vancouver being a very desirable real estate market and some of the lowest cap rates in the country, all of that's producing higher valuations for hotel properties. So the limited supply piece is part of the reason that we are seeing occupancy rates increase to what are record levels at this point. So we've got higher occupancies, the limited supply pushes average room rates up. So we've got this compression effect in the market, and that's really driving the performance of hotels. In the long term, what we'll see at some point, and we're already seeing activity in the pipeline, is we'll get new hotels built because the market continues to be stronger and stronger as we go forward every year. Well, the real trend in terms of performance of hotels is the growth of the top line. So we've seen post-COVID revenue growth very, very strong. There's been compression, which has created occupancy growth. Average room rates are improving. So the good news story is the top line. Throughout the pro forma of a hotel, though, there has been expense creep. So labor rates are increasing. There's been some significant union negotiations that have resulted in increases. So that's the downside for investors in terms of interest in the hotel piece, is that as we've seen revenue growth, we haven't necessarily seen net increase in the percentages to the bottom line. In aggregate, the number's gone up, so values have gone up, but actual percentage improvement or profitability increases have been hard to achieve. Well, if we're talking about Vancouver and the competitive landscape by 2028, there won't be a lot of material changes. There aren't that many rooms that are under construction in the city at this point, so the outlook in the short term is actually very strong for hotel performance. We expect there to continue to be compression in the market, continue to be growth in occupancy and average room rates. So the near term is extremely positive for hotel performance. This compression is likely going to drive some long-term supply, but I would see that being into the next decade. So 2030 and beyond is when some of the larger projects might come to fruition, and we would see increased competition. But for an existing hotelier in Vancouver, or existing ownership group, now would be the time to be thinking long-term and making sure that the investments are going back into the property to retain the customer and to really solidify your market share before there is that new competition, which is probably 4 to 7 years into the future.